Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up. Now, if you're not on my free email list, you need to get on it. Go below this YouTube video into the description, and you'll see a link to get on my free email list. Then you'll get an email from me before the opening bell Monday through Friday for my market commentary, headlines, to what I think are the most important stories of the day. Now, what we want to talk about today is Robinhood and what small investors are doing in this market, because it's going to give us an understanding of what's really happening in the stock market and when this bear market is going to end. Now, I define a bear market as a market trading below the 200-day moving averages, and those moving averages are acting as resistance. They act as support in a bull market, but in a bear market, they act as resistance. And they've been doing that now for well over 6 weeks, really longer than that when you look at the Russell 2000, and even longer than that when you look at things such as the ARK ETF. But now the NASDAQ is below it, and the moving average is starting to curl down. Classic stage 4 decline. And this is having a destructive impact on small traders and investors. We saw millions of people enter the market for the very first time in 2020, opening up Robinhood accounts. And last week, when Robinhood reported earnings, we found out that they lost $392 million on $299 million in revenue, and that 11% of their user base went from being that were categorized as monthly active traders were eliminated. We're talking about 2 million people, 2 million active traders eliminated in the first quarter of this year that have Robinhood accounts. Now, a year ago, in January and February of 2021, we saw the rise of AMC and GameStop and a short squeeze in Reddit message boards became something talked about across the entire country. And on the news stations, Rachel Maddow and Tucker Carlson both were united in saying that the phenomenon of the rise in a GameStop, AMC, and the Robinhood trader and the Reddit message board all signified the rise of the individual trader as being able to conquer and beat the hedge funds in Wall Street. And it was asserted that if you could open up a Robinhood account, put some money in it, you could be a part of this, because the game would keep going on with more people entering the market, sort of like a pyramid effect, where you could get into stocks regardless of fundamentals, even if they're bad companies or losing money, such as AMC and GameStop were doing, and you could make money in this pyramid effect of more people entering the market, more people trading, more people buying the stocks, and stocks were then therefore called stonks. And that was a popular phrase and a popular meme 13 months ago. And now here we are, and all that has turned out to be, it didn't happen. It was a false promise. It was actually the very peak of the power of the Robinhood trader was at that moment. And since then, the stock market has fallen, and many of the fad stocks that drove the market higher in 2020 have fallen much greater than the market averages and have crashed and collapsed. The ARK ETF itself is in a horrible bear market. And so 2 million people have been wiped out. And one way to look at this is that the idea that the stock market is driven by more people entering the market, more people buying stocks, in this money flow effect is now in reverse. And that's really what drives, one of the factors that drives the bear market. We could talk for hours about all of them. Fundamentals are important part of it. Valuations, interest rates, many factors. But one factor is certainly money flows and the rise of small traders. And when they peak out, that pattern of small traders entering the market peaks out and goes in reverse. That is part of what drives the bear market. And this happened with, let's say, the real estate market in 2006. There were people flipping homes, people speculating in real estate. And when that peaked and went in reverse, real estate prices went down. And I began in the stock market in the 90s as a day trader. And day trading was a phenomenon. I'll talk about that in a second. Actually, I want to show you. I wrote an article about all this stuff that I put out Friday, and I want to show you a picture from this article. And then we're going to look at some charts, look at what Robinhood people are really doing, and understand what I wrote about even better. So it takes my screen a few moments to load up. But this is a picture right here of a day trading office in the year 2000. And in the late 90s, there were supposedly around 60,000 people day trading like this, and many more in their homes, obviously. And internet stocks were the rage of the day. And what happened was, after the stock market topped out, these people were completely eliminated from the market, and all these day trading offices shut down. And when they were all closed up, the bear market was over. So this bear market that we're in now, one of the things that will end it is when this process of all these Robinhood people who really got in over their heads are taken out of the market. And it's begun. In the first quarter, that process has begun with approximately 2 million of these people, almost 10% roughly of the Robinhood monthly active trader base, eliminated from the market. It's a lot of people. But I think, sadly, the process has only begun. Now, I opened up a Robinhood account so I could see what is it that the people are owning, and what's it like to be a Robinhood trader. And when you load up a Robinhood account on the app or on this, what you're seeing is the desktop here, this is what you see. They flash at you lists of what other people are buying and owning to make you do the same thing other people are doing. So it creates a herding effect. But unfortunately, this also encourages people to get in the worst investments possible. So Robinhood literally guides people into crypto coins, which of course are in a bear market too, falling much worse than NASDAQ. A newly listed crypto, the most speculative things you can buy is the first thing that Robinhood guides you into. So one reason that these Robinhood people are wiping out is because Robinhood encourages them to take on extreme risk in the markets. And if you go through the 100 most popular Robinhood positions, it's ranked by the number of people that own them. Okay, Apple's not so bad, but when you go through the list, it's dominated by stocks well below the 200-day moving average. AMC is number 3. Sundial Growers is on the list. Amazon had a horrible earnings report last week and dumped. Disney's in an awful bear market. It's one of the worst performing stocks in the Dow. Meta Platforms crashed in January. Netflix crashed twice, once in January, once just the other week, falling 30% in a day. Lucid is a disaster. NVIDIA has become one of the worst performing stocks in the NASDAQ after having been one of the best performing stocks of 2020. I could go on and like this, but this is what's going on. For the most part, 90% of these positions are junk, trading below the 200-day moving average and lagging the stock market. What's bad about a stock or a sector, when it lags the stock market averages, it goes down worse than the market when the market has a down week. It doesn't go up as much to make up for those losses when the market has an up week. So it's awful. if you want to beat the market, you want to do the opposite. You want to be in sectors and stocks outperforming the market averages. That's how you beat the market, not by being a herd trader with a Robinhood account doing what everyone else is doing. So it's no surprise that when the market conditions change from going straight up like they were doing in 2020 to going down like they've been doing the past 4 months, that Robinhood people suffer more than other people do in the market, more than regular investors do, and wipe out, and liquidate. But selling is what drives bear markets lower. And so part of that selling does come from individual traders that are over their heads and are selling and liquidate and give up. And some selling comes from margin players. Some selling comes, from hedge funds that got positions that aren't working out and so forth. But what's interesting about the Robinhood trader and the individual self-directed investor in the market is we can see their activity. We get updates of their activity in the earnings reports that Robinhood has to release every 90 days. We can load up the app and see what they're owning. We could track this actually and see the positions go up and down and get a feel for what they're buying and selling. But we can go beyond that. And I want to show you what people are doing in this market, and it will show you why we know the bear market's not over yet. In a way, we'll be able to know when it is. And that is valuable information. So you can turn on CNBC on a down day like we saw Friday, and within 5 minutes, you'll find an expert saying that the bear market's over and stocks are going to go up, so you should buy. Now, there'll be someone saying that every single day. And Kramer, in fact, was saying that on, I think it was Wednesday. And then the market dumped, and he was, that call was wrong. So you can't really, it's like, these are like weather experts. The weather experts can't really predict the weather on a consistent basis. They can give you a good forecast that the season's going to change because the weather seasons are a cycle that repeat over time. So it's not that hard to identify when you're in a bear market cycle or a bull market cycle. You're in a bear market when things are trading below the 200-day moving averages as they are now. And we had plenty of warning signs of the thunderclouds last year. And I talked about it. The internals doing worse than the averages, for example, was one of them. So on one sense, you can tell what kind of market you're in. Just as the weather forecaster on the television set can tell you it's fall, it's winter, so more chances of snow in the winter than the summer, which is meaningful in your day-to-day life. Should you wear a jacket when it's likely to be cold? Well, it's likely to be cold in the winter, but not the summer. Well, in a bear market, if you just buy any random stock, you're likely to lose money. Something worth knowing. So you can be patient and wait for that bear market to play out before you try to buy any random stock without any real strategy. The only thing that really works is buying sectors and stocks vastly outperforming the market averages. And that's more important in a bear market than a bull market. But anyway, I said, there's a way we'll be able, there's one sign I'm going to show you that we'll be able to know when the bear market's over. And that is valuable information. You don't need me to tell you. It's not a prediction. It's something you'll see happen. And that's valuable information. So what am I talking about? Well, it's not this Robinhood thing, although it's fascinating, but Fidelity also has a page that, and I'm going to link to it below the description of this video. So you can look at this every day from now on. But look, the NASDAQ was down 536 points on Friday, down 4%. and it made a new closing low for the year, broken down. It had a rally attempt in the middle of the week that failed. Same thing happened the week before. Same thing could easily happen this week. We could get an update, especially after the Fed has its interest rate meeting on Wednesday. There could be an update. It could be 2 or 3 of them. But that doesn't tell you that the bull market, the bear market is over. You know, one update is meaningless. We've seen plenty of updates. You need a better indicator than that this bear market is over. Well, there's the way bear markets end. Remember, they're driven by selling. They come to an end in capitulation. So look at this thing here. They're all these little things are saying the same thing, but at the top of a bull market, people have euphoria. They'll also think, I'm really smart, I'm making a killing, this is easy. That's the Robinhood trader, the way they were feeling in January and February of 2020. The game is completely new. It's a revolution. Well, and then things peak, they start to decline, they see some losses in their account. They buy something, it doesn't go up, like the trades don't work like they used to work. They get anxious, but they don't really realize or stop to think, is anything changing? They're in denial of the real situation. And there can even start to be negative news. Inflation is a negative story. And they'll somehow say, oh, it doesn't matter. Oh, the Fed is raising interest rates. Oh, somehow that doesn't matter. But it does matter. And the losses grow. Then they'll become fearful. That's the next stage of the psychological cycle of a bear market, the way things play out. Then they'll end up getting depressed about the losses they are incurring, but they'll still hold on because it's like a lottery ticket. If they cash out, then they're giving up on the lottery ticket. They don't want to do that. But then, oh, the losses get even bigger. And now they're getting so big that if they lose more money, it's like they're going to be, they don't want to lose more. They start to panic, and then they sell and they capitulate, and then they become despondent. And then the market may bottom, but they're still depressed over everything that happened. And so they don't buy when the next cycle, the bull market, begins. But this is the key thing. Corrections in the bear market, they end in selling panics too, but they're not mass selling panics. Bear market real bottoms and ends in a big selling panic where just about everyone gives up. A whole generation of investors give up. The day traders give up and never enter the stock market again, move on to something else speculative that they see going up and try to repeat the same behavior. So there are a lot of day traders that gave up in the 2000 to 2002 bear market, then went into real estate, trying to flip houses. There's a lot of people that got into gold and silver, and gold and silver peaked in 2020, and they gave up on silver and they got into crypto. So that's what a lot of people do. They give up on one asset class or one market, then jump into another one. But that's not, and then repeat the same behavior and lose again. Instead of sitting back and saying, okay, I didn't understand what I'm doing, I need to understand what I'm doing. And my hope is my videos provide this type of understanding and educate people that watch them on how to be a better investor and trader. So anyway, remember that a huge breakdown Friday, big down day, the Dow down over 900 points. But Fidelity, this page on Fidelity shows live what people are doing, the number of, or they've ranked all the positions in the market, all the stocks, ETFs, by the number of orders going to them, the number of trading orders they're receiving, and they rank everything by that. So number one was Amazon on Friday. Amazon had 25,000 orders by Fidelity customers. Next was Tesla of 18,000. After that was Apple with 16,000. And then ProShares QQQs with close to 10, than ProShares ultra short QQQs with roughly 8,000. So this update's live, but it does something even better than that. It shows you how many of these orders were buy orders and how many of these orders were sell orders. So if stock market corrections in bear markets end with capitulation selling, then the day that this bear market ends, there will be mass selling by individual investors. Self-directed investors will go through a mass panic of selling. That doesn't necessarily mean that the stock market has to have some giant crash or decline on that day. Not at all. It could be a small declining. This could be a small drop on that day after a week or month or a couple months of drops. I'm not trying to predict how that will play out. All I want to tell you is that the day this market bottoms for good, there will be mass panic selling. And that selling will show up on this page. This page will be full of sell orders. But on Friday, it was full of buy orders. So the number one traded stock was Amazon, 19,500 buy orders and only 6,500 sell orders. And the stock was down 14%. The whole list is dominated with more buys than sells. So that means that stocks were declining. Amazon 14%. Even Tesla was down, Apple down 3%, Facebook down, on and on and on. And this list was dominated by more buys than sells. For example, the Vanguard Fund, 2,200 buy orders, only 141 sell orders. That's a buying panic, not a selling panic. GameStop, 1,800 buy orders, only 448 sell orders. Remember those QQQs I talked about? The triple QQQs, it's a leveraged 3 times ETF on the QQQs. 6,400 buy orders, 3,200 sell orders. The number 5 position was a short ETF, a triple short ETF on the QQQs. 3,300 buy orders, 5,000 sell orders. So in other words, an ETF designed to short the market that some people are using to hedge their long positions saw sell orders by a 5-to-3 ratio. The one position on the list with more sells than buys was a short position. So the stock market broke down on Friday, a big plunge in the Dow, 900 points, and individual traders were buying much greater than selling. That's not a selling panic. And that's a sign that the bear market is not over. Yes, we saw a liquidation of 2 million Robinhood traders in the first quarter. But here's what's going on. That is going to likely continue, and we'll get updates on that every quarter. And what that represents is people getting out of the stock market. But what this represents, this Fidelity screen, is what the people in the market are doing. So it's one thing for someone to get out of the market. This is what people in the market are doing. And you think about the two things together. And when you look at this and you realize you're in a bear market and people are only buying, you realize this is what keeps the bear market going. It's that the liquidation process isn't really over at all. Doesn't mean we can't have bounces and rallies, we will. But watch this page in hope, and the day will come, hopefully sooner than later, that I'll be able to do a video saying the day has come. We can ring the final bell, the end of the bear market. And it's not a prediction. It's what is happening in front of our face. And that's what we got to focus on. What the charts are really showing us with the trends, and stick with them, not crazy predictions and hopes of what's going to happen, but what is really happening And that's the only way to navigate a market like we're in right now. And when you're in a bear market, you've got to have the ability to buy when it's over. So if you're on margin, you don't have that ability. All you can do is sell if things fall more for big losses, because in risk, if you hold on margin, that you'll be forced into liquidation. So the riskiest thing someone can do is be on margin in a market like this. And I think cash reserves are necessary. And the only way to be able to buy when the bear market's over is to have cash reserves. Now, I'm not saying go 100% in cash. I'm not 100% in cash at all. I own a lot of money. A lot of my money is invested in gold, in commodity related ETFs and stocks, energy stocks, mining stocks, all sorts of things that have actually gone up this year and not down. Doesn't mean they can't have their setbacks and pullbacks, because they will, but they're all trading above their 200-day moving averages. You look at, for instance, the XLE ETF, which I have a small position in my IRA. It's trading above the 150-day and 200-day moving average. That's the red line and the green line on this chart. Compare that to the ARK ETF, which is, almost 40% below those moving averages and in a complete collapse. Short ARK, buy energy. That could be a play. I'm not exactly doing that specifically, but it's, someone could do that, and that would be a good way to position oneself with some of their money, But anyway, I hope you learned from this video, and we'll watch that Fidelity thing. Watch it day by day. It's interesting to take a look at. And if you like this video and this type of content, hit the like button. That encourages me to do more videos, because it gets YouTube to show the videos to people and increase the count view. And if this is the first time you see me, hit the subscribe button and then hit the bell next to it, and YouTube will send you an alert the instant the next video I put up is up for you to watch. So it'll be an interesting week. The market volatility is not easy for anybody to navigate. Don't want anyone kid you on that. I much prefer a market like 2020, but that's not the situation we got, and we can only deal with that.